All right, guys. So we got today Disney earnings. Give me 1 second. Let me pull this up. Running a little bit late. Side chart. Let me pull. Yeah, you can see the E-mini breaking down a little bit. We do have earnings for Disney today. It's Q3 earnings. Bear with me. Let me get all this stuff up. You can kind of see Tesla on the left. You can see Disney here. Disney had a good day yesterday. I haven't looked at it today. It looks like it pulled back a little bit today, but it had a really good day yesterday. And so we're still pretty green in our Disney trade also. Yeah, I don't know what they're going to do for earnings. I don't know if they're going to beat or miss or what they're going to do. Let me look at what the expected numbers are. I'm holding Disney right now. My average price on Disney currently is $86.39. So we're holding a couple shares of it. We're going to do a poll here as well, get some music going also. We're holding a couple shares of it. We're going to do a poll here as well, get some music going also. We're holding a couple shares of it. We're going to do a poll here as well, get some music going also. We're holding a couple shares of it. We're going to do a poll here as well, get some music going also. We're holding a couple shares of it. We're going to do a poll here as well, get some music going on. I might have to reshare. Go here. I think I'm playing. There we go. Let me turn that off. All right, I think I fixed that. All right, so yeah, Q3 earnings for Disney today. We also have plug stock earnings. Let me get all this up and running. We're also going to do a poll here. Vote on the poll. Also, we are going to do a Twitter poll as well. Disney earnings for me are really kind of hit or miss, to be honest. Like, I cover them every year, but again, they're typically kind of hit or miss. We're going to do a poll right now. Make sure to vote on the poll also. I'm going to try this new drink, man. It's supposed to have nothing but caffeine and sparkling water with mint and cucumber. Every time I drink anything, I get like nauseous. So we'll see if this helps. We're going to do a poll, bullish, bearish on Disney Q3 earnings. Bull, bear, and neutral will be the options we have. And then, yeah, you can see Tesla. Disney's on the left side. We'll make Disney a little bit bigger than Tesla here for you. Yeah, we'll make Tesla a bit smaller. Again, we'll put up Disney chart here as well. Disney, we can put up like maybe a 5-minute chart. Maybe a 15-minute chart, actually, just to kind of show the previous history of Disney, which has kind of been neutral since 7/17. It's been going up and down around $85 to $90. Disney today is expecting 99-cent EPS profit. We'll do a poll. And they're expecting 99-cent profit per share. Yes, on 20.3 billion in sales. Or in revenue. They beat or miss. What's up, Justin? What's up, Roger? What's up, Kryptonite? Again, a lot of stuff pulled back today, but Disney's still green over the last couple days. Roblox had a big dip. We're green on Exxon, Honeywell. Bitcoin under 31. Where's Bitcoin at now? I know Bitcoin broke over 30K earlier in the day, but it looks like it pulled all the way back to 29,500. So we're going to do a Twitter poll also here. Let me get my Discord up. Again, Disney earnings really are hit or miss. And so, again, we'll see if we get any good action. The market's been slow. Typically, the market, like August is a really good month for trading, but September is the slowest month. And so typically, I've been running this channel for years. Typically, we get a little bit of a dip, and I think most people do around this time after this earnings season is slowing down. And it doesn't really start to heat back up again until October, November, December, January. You know, so September is typically a pretty slow month. We're gonna do a poll on Twitter also here. Again, let's put it up. Disney again expecting 99-cent profit per share on 20.3 billion in revenue. We also have again Wind, Plug. We have Wind, Plug, Power, CGC, Canopy Growth Company, which is a cannabis stock. A lot of you guys might not know it. It's older. It's not doing that great lately, if I remember correctly. Here, guys, I'm gonna have to mute this. I gotta take this call. It's a business call. All right, sorry, back. Business call right there. What's up, Bal? All right, bro, the day has just been busy, man. It's been a busy day. My kids started school, man, and honestly, I got a lot of business stuff going around right now that I'm trying to figure out. This drink is actually really good. It's got to be better for my stomach. And it tastes good, man. It's cucumber flavored. And I'm not really a big cucumber guy, but that tastes good. Anyways, man. All right. Disney to $100. Honestly, bro, Disney is probably the stock. As much heat as people give me for Disney, Disney is probably the stock that I am the most profitable on, I think, right? Like, Disney is one of those stocks that I have just done incredibly well with over the last, like, year or two. And if I pull up my trades here, like, if you want to see my trades in Disney overall, like, we put up if we put up like a daily chart here and I put up like my actual trades, you'll actually be able to see them. And so people give me some heat for it, but like, I trade Disney a ton. And just to show you, like, y'all aren't even going to be able to see the buy orders because the buy orders are like the screen, it doesn't fit. But if y'all want to see how much I trade Disney stock, some of these orders, again, this is not all the orders. There's many other orders below it down here and down here. Like, because I guess it can't fit. So like it's got to squeeze in more orders. But yeah, we trade Disney very often. We're green on it again. Disney's one of those stocks that like it might pull back, it might not hold great, but again, my trades on it have been incredibly profitable, to be honest. But again, let me know what you guys think. I might turn the lights on in here. And again, if we look at Disney stock, let me pull this up. If we pull up Disney stock here, and we pull up, what is this? This is EPS graph. So here's Disney's EPS graph. I don't think their PE ratio is like terrible either, but like here's their EPS graph, right? So if you don't know what EPS is, it's earnings per share. It's a gauge on how profitable the company is. And you can see that we're really rolling in it up until 2018, kind of the heat of the Star Wars movies, I guess. Disney Plus, you know, the first season of The Mandalorian. My daughter and I love that show. And again, they've kind of gone down a lot since everything else pulled back since 2020. So again, they're expecting a larger EPS reading than they've had since 2019. So the last time they expected, or the last time they showed a higher reading than what's expected today was back in 2019. And so if they hit that today, which again, I'm not saying they will, if they hit 99 cents per share, that'll be a higher EPS value than they've had since 2019. So that's an interesting story of this earnings report. Yeah, I mean, Wall Street bully, to be honest, man, I think the way you have to approach it, even if you're bearish on Disney, which I understand, like I really do understand it. But like, even if you're bearish on Disney, like, again, I'm going to say this because this is just the truth, right? Like I've been trading for years and years. The people who are the most definitive with what they expect to happen from earnings typically know the least in the stock market, because if you experience and actually have experiences with earnings in stocks, you know that nobody freaking knows what's going to happen with earnings, especially relative to bank expectations. Like these EPS values expectations are not we're not basing it off of what they showed last time, you know, which would probably be even better. We're basing it off of the banks and in the analyst ratings, and so we don't know what that's going to look like. And again, typically the people who are the most definitive and especially like insulting typically know the least in the stock market. You know, they're usually just kind of emotional about their own positions, which is okay. I mean, listen, do what y'all do, but yeah, it's not a good look. Yeah, I mean, Disney Plus, it was growing really fast a few years ago, but again, I think Disney and other companies like it have taken a lot of heat the last year for sure, and that's something I think you got to look at objectively as well, and you know, use that to analyze what their future looks like also. So the earnings release on Disney is at 4:05 p.m. and the earnings call is at 4:30. So at 4:05, the earnings call drops, or the earnings report drops, and then 25 minutes later, you get the actual call. All right. Last month I may have thought this would go up. Not sure now. Yeah, I mean, I think I think the first step, like, if you guys want to know how you analyze stock price and value, right? Like, number one, separate yourself from bearish traders and bullish traders. You got to look at things objectively here, in terms of just emotion, right? You got to look at things objectively. We're always going to have bullish or bearish traders, but I think you have to look at the numbers objectively. You're always going to have people that hate a specific stock. You're always going to have people that love a specific stock. And again, I'm in those categories, with a bunch of different stocks on both sides of those. And so, number one, you got to separate yourself from emotion. Most people that are really loud with like hating a specific company are typically doing it for political reasons. Like, they have a lot of political bias against, especially something like Disney. And so for whatever reason, they just take it as a moral fight for their political party or whatever it is. The other ones are people that are holding positions. So if you're holding a really big put option position or a really big short position, you might be kind of emotional about what could potentially happen. Same thing if you're holding a big call option, or if you're on the upside and you're holding a big position there. Again, you might be pretty emotional about that. Again, if you're looking to analyze true value of companies, I think there's a couple different ways you have to do it. The first way is just looking at the PE ratio. And so, for instance, like with Disney right now, if we look at PE ratio, Disney's is currently about 39, which is okay. It's not a bad PE ratio. It's not like it's incredibly overvalued. To put it in perspective, Amazon, for instance, currently has like a 111 PE ratio. So Amazon, for instance, has like 2.5x what Disney's PE ratio is. Apple right now, I believe, is a little bit better than these. Apple currently has a 30 PE ratio. So Apple is currently a little bit more undervalued in terms of price to earnings than Disney is. But again, I think you got to really separate yourself from that. And first thing you look at is a PE ratio. I think right now, anything, depending on whether it pays divvies or not, anything under 40 is decent right now for PE, in a time where everything's kind of overpriced, inflation is out there, it's rampant. Again, a PE ratio under 40 is not terrible. It's not great. Conventionally, ideally you want like a 15 for a PE ratio, which is great, but you can't always get that. And I think, if you wait too long for the perfect price, a lot of people are just never going to invest regardless. And so I think the first thing you got to do is look at the PE ratio. The next thing you got to do is you kind of have to have this thought experiment of like, okay, analyze the company in your head and picture whether that company is going to be around in 5 years, 10 years. If the answer is yes to that, imagine whether it's on a decline or, whether it's appreciating in value over time. That's another thing. And then again, look at the graphs for both revenue. Here's the PE ratio, or here's the EPS graph for Disney, which again had a big slump with everything else in 2020, and then has slowly been increasing. And then if we hit this one, it'll be the best one since 2019. And then we can also look at revenue. So you can look at the same thing. This is on a site called macrotrends.net/stocks. But if you do the same thing with like Disney revenue graph, you'll get the same type of thing, but instead of EPS, which is a gauge on profitability, it's going to be revenue. And so to put this up there, again, their revenue has been trending really, really nice. And this is kind of what you want to see for a revenue graph. Now, again, revenue is kind of like potential. Revenue is kind of like how high is the ceiling for the company. And again, Disney's revenue looks pretty solid. The graph looks great. Again, if we're comparing the two together, the last one showed at 21 point something. So again, this revenue, if we come in as expected, is going to be a little bit underneath that. So it's going to be a little bit underneath this if we come in as expected, but we could always beat it. And again, we'll see what happens there. But yeah, that's the other things you want to do. And all of those, you kind of want to, if there's dividends in play, typically they might have a lower PE ratio, as well as like, you can use that to influence whether you want to hold longer or whatever that is. But I think everybody has to kind of develop their own system. Again, I mean, Wall Street guy, I don't know if you're insinuating I don't have positions, but I mean, bro, number one, I'm in it right now. But like, this is me over the past 52 weeks of Disney. I trade a 30,000, 100,000 buying power account, man. And again, Disney's probably the stock that I'm the most profitable on, but I certainly don't hold it forever. And I typically take profits pretty quick every time I'm in profit. So I kind of buy dips, sell the rip, buy dips, look for established support long-term, and then try to play kind of a mix between swing trading and investing, to be honest. It's something like that, but yeah, I hope it goes to 110, Sticky. I hope so, man. Never listen to a man talking money streaming from a kitchen. Bro, why is everybody hating on my office today, bro? Do y'all really think this is a kitchen? You know? I got the nicest office in town. Definitely top 3 offices ever, bro. Look at this. I got my play button right here, man. Don't hate on my office. Okay, look. This is my library, actually. You know, if you want to talk, I mean, listen, this is my library in here. Look, there's my house. Not in the kitchen. There's my dining room right there, bro. Again, not a kitchen. This is a wooden office with a library, sir. Get it right. Definitely top 3 wooden offices with a library in the world right now, for sure. Anyways. We'll see what we get here. I put money on 5 minutes before the market closes, before 2 people get paid. Yeah. Take the over-under here. Pawn and I sometimes do that in the back end, man, where we're taking the over-under on how long somebody will last. That's a little game we play. Typically, we're both on the same side, though, which is the under. If Disney dips on earnings, yeah, I might buy a little bit more. We'll see. Waiting for grandma to walk by. Yeah, I've heard I'm living in my mom's basement. I mean, if I didn't have kids come in here and say, like, goodbye every day before school, that might be a little bit more believable. But yeah. Freaking Roblox, crazy movement today, man. Again, is Roblox worth a buy right now? It might be cheap enough too. I don't know. Coloring books don't count as a library. Honestly, dude, I got some good books in here, man. Again, I used to have a used book business. I told the story this morning. That's where a lot of these come from. I got Dave Ramsey over there. I can see it. If I'm being honest, a lot of these were bought at Goodwill at like the thrift shop for resale purposes, and then I shut that business down like 5 or 6 years ago, and I just had like a bunch of different books. I had like thousands of books, and so when we bought this house, I had a place to put them, which was, you know, what you guys see here. All right, guys. Hey, 10 minutes, 10 minutes. I want a minus 5% drop for my puts to print. Yeah, I've been thinking about buying some put options also. How much is a Roblox call option right now? I don't know if I want a put option, but how much is a Roblox call option right now? Roblox is down a lot. Like, it's down like 30% today. I guess it depends. So I could buy a September 8th call option for about $250. $29 call option. I could buy one of these, man. Let me see. I definitely don't want 10. What's the buying power implications on a... So this would be... Say I buy a... I like the October ones, though, dude. Honestly, the October ones are nice. Here's a $30 October call option. $30 October call option. I'm gonna buy some. Don't judge me here. Let's just take these in market. All right, I just bought it. It failed me. Okay, so now I'm holding 2 Roblox October 30th call options. We'll see how those treat me as well, honestly. We got 6 minutes, guys. 6 minutes before these numbers drop. Again, Roblox, I think it'll move independent to the market anyway. Never bet against a mouse. Yeah, hey. All right, guys, we got 6 minutes, 6 minutes. Disney earnings actually aren't scheduled to release until 4:05, so we actually got about 10 minutes or so. Right, let's check out these numbers. Oh, dude, I forgot to freaking post my poll. All right, so now I'm gonna have to switch it. Disney Q3 earnings call starts soon. All right. An associated Disney stock. AMC, maybe? I don't know. Y'all do me a favor, hit the like button as well, team, if you haven't already. We appreciate it. What the heck did I just do? Okay. All right, we're just gonna have to select one. Yeah, I'm slacking on this poll today, guys. Again, it's been a busy couple days. My kids started school. Again, we're gonna see how many of you guys actually support this channel. Vote on the poll. We'll see how supportive you guys really are. Hey, thank you, Mr. Seymour. A good stock at such an affordable price. I think it's probably arguably cheap. But or you mean Roblox is what I'm assuming you're talking about, right? So yeah, I got a couple different positions on it. By C3. Yeah, we also have Plug Power, The Trade Desk, Win, Sonos, ADMA, Kano, Car Gurus, Jazz, a couple other ones this morning or this evening. Most people are bullish though on the polls that we have going on. Again, looking at our actual YouTube poll, 50% are bullish, 39% are bearish, 12% are neutral. Yeah, we'll see. I think it's arguably cheap, but again, I think it's certainly not the most predictable thing ever right now. Again, we'll see if it holds. I don't know. There's Disney on the left. It's starting to dip down a little bit around the earnings report. We still got a couple minutes before the release. You can see the 15-minute chart on the right side here. But yeah, we'll see. All right, so yeah, so 67% of people are bullish, 33% are bearish. Starting to get a little bounce up. Yeah. Wait, so did you just buy one pawn or are you just helping me out showing me that? Again, I like longer term options. I've been kind of establishing a longer term portfolio. Yeah, this put option I bought was in. Yeah, currently we're already up about $20 in it. We only bought 2 bundles of it. It's an October 23rd $30 strike price call option. I think that's just a good option, man. I think that gives it plenty of time to stabilize and bounce back for Roblox. I think it's really low right now. It's down like 25% on the day. All right, guys. So here's the closing bell. Again, Disney earnings are scheduled to drop at 4:05. We do have plug power that's supposed to drop like right at the closing bell. What I do like about this, my favorite thing with earnings calls is this: when they have the earnings call really close to the actual earnings release, which is rare. Usually they don't do that, but today they did, which I'm excited about. So again, Disney's earnings call starts at 4:30. Their earnings are supposed to drop 25 minutes earlier at 4:05. So there's the closing bell. Again, we'll see if it holds. Right at the close, getting a little dip. Again, here's a 15-day chart just to show you, like or a 15-minute chart. We kind of had choppy movement here. Overall, we've had a pullback, especially since the 90s. And I think there's just an argument for it being cheap down here. But again, you never really know. Do you trade for a living? No. Yeah, I certainly don't live purely off of my trading or anything like that. I wish, and I trade some like decent sized accounts, but I certainly don't live. That's too much pressure, to be honest, to rely let me think of the easiest way to put it. It's going to be incredibly difficult for a large majority of people to live solely off of their trading profits. And that's not how wealth is made anyway. One income stream is typically not how wealth is made. Typically, you need to have one good performing income stream. And then through that income stream, you take that money and you put it into other things that sprout out and branch out and help create other income streams. But to rely solely on trading profits there's Disney Pump It Up, seems to be a bad move. It's going to make you more emotional. All right, still nothing out for Disney, but Disney is bouncing up a lot right now so far in after hours. I don't think the numbers are out. I don't see anything on my end here, but that is a pretty big upward move. Again, I guess there's a little pullback. So it's definitely not the earnings report. You'll see it when the earnings come out, but we're already up to $88 in after hours, which is great. We kind of moved back on some of the earlier pullbacks we had faced. There's $88. Breaking that now. There's 88.50s. This might be the actual release, and it looks like this is. It's something. I don't know if it's the release. I don't see anything for it. There's a dip down to $88. At $88 right now, again stabilizing here after breaking over the 200 EMA. Again, I don't think anything's out yet. I'm not. Again, they're scheduled to release in about 3 minutes. We got a little dip. All right, so Disney still consolidating, not really doing much yet. Little bounce back up. Disney consolidating right at 88 bucks. And again, to put it into perspective though, I'm not holding a huge position. And again, so no matter what, it's not going to be anything super major. Disney's still turning back down. Again, we still have less than a minute now before their earnings are actually set to release for Disney. That's if they drop on time, which they typically do. Let me pull this up so we can watch it. So the president is set to sign an executive order to regulate future U.S. investments in a narrow set of technologies in China, Hong Kong, and Macau. Disney's starting to break down, test the lows, and then bouncing back up a little bit. Again, the earnings are set to drop in about 30 minutes. We got about 400 people here. I'm going to put it in sub-only mode. So yeah, we're going to throw it in sub-only mode. So if you haven't yet already, hit the subscribe button, hit the notification bell. We appreciate it. Another little pop back up to $88. Consolidating really right around the volume-weighted average price and the previous closing price. Here's the earnings release right now. This is when we should see volatility. There we go. There's the volatility. Pull back to 85.70s. Wynn just released their numbers as well. All right, so it looks like Disney ended up showing. Let's wait for it. Again, my position's small enough to where if we dip enough, we could add more to it. But again, that's a big candle wick. So again, Disney earnings are out. Disney ended up showing. Look, there's the retracement all the way back up. I'm looking for him. Let me see if I can find him. Big retracement back up. All right, Disney showed 103 adjusted EPS versus 99 estimates. Third quarter revenue came in at $22.33 billion versus $22.5 billion expected. Again, so higher than expected EPS and revenue. So better than expected EPS or revenue. And I think this is the largest EPS they've shown since 2019, as well as the highest revenue. I think, let me look at my back at my revenue graph. All right, so they showed 22.3. Okay, so yeah, this is their second highest quarterly revenue ever. And they had better than expected EPS and better than expected revenue. And we didn't get a chance to add to it, and maybe we should have, because Disney popped all the way back up, and now it's retracing a little bit. But honestly, it's kind of flat from this release. We'll look for guidance numbers here. See if that gives us any window into it. So Hulu paid subscribers came in at 48.3 million, lower than the other consensus analyst estimate of 48.6. So slightly lower than expected third quarter Hulu paid sub revenue. That's another data set I see. But again, we're pretty much flat here on Disney. We're not really moving that much. Yeah, I mean, it's pretty much, it's moving, but it's flat. I mean, you can kind of see this is where we closed. This is where Disney is now. So again, so to read this again, guys, Disney ended up showing 103 EPS versus 96-cent estimates, revenue of 22.33 billion, expected 22.49 billion. So actually, wait. Okay, so they actually missed on revenue is what this is. So Disney missed on revenue. I'm sorry, I didn't realize they missed. I was showing they only expected 20.3 billion. And so I guess it depends on what your source is. But for some of the sources, it looks like they were expecting 22.5 and they showed 22.3. But mine showed 20.3 billion was the estimates. And so I'm not sure which one it is. Illumina Incorporated also dropped their numbers. We also had Wynn. Wynn did better than expected EPS. Revenue was better than expected as well. We'll put the Wynn numbers up in chat so you can see them. Again, it's mostly just flat. Maybe the earnings call will give us some better movement. Anybody hear that? Ouch, man, that hurt, dude. Close this. Again, Disney, I'm still green on my trade too. My average was 86.30s. We're at 87 roughly right now. weird, man. My headphones are weird. I'm gonna switch. Charge these. This should be good. Disney's starting to move back up a little bit, so we are starting to bounce back up some. Let me share my audio again. Honestly, we're really flat. Disney right around $87. Back up to over that now. You know, honestly, what I'm noticing is that Moomoo's a little bit faster than Toss as well. They're pretty similar, but in terms of like market reactions, it's a little bit faster. Yeah, the Disney call is going to be in 20 minutes, guys. 20 minutes. And so starting to get a little bit of an upward trend. All right, so again, we do have the call. Nice, so now we're getting a dip here. Again, we've been pretty flat since the release. We dropped initially at the beginning, and now we're basically sideways. We're starting to get a breakdown. Now, let me see if they reported any more data here for us. Okay, so yeah. The CEO, Bob Iger, says, I'm incredibly confident in Disney's long-term trajectory because of the work we've done, the team we now have in place, and because of Disney's core foundation of creative excellence and popular brands and franchises. And so we'll put some of these quotes up in chat. So again, we're going to put some of this news up in chat, and the actual call starts in about 18 minutes. Disney third quarter parks experience and products revenue came in at $8.3 billion. Segment operating income came in at $2.4 billion. So again, we're dropping all this stuff here, but again, we're pretty flat. Not really doing that much from this. Disney Plus core third quarter subscribers came in at 105.7 million, which is up 1% quarter over quarter. You can see that number right there. Again, inflation tomorrow is going to be big. Who? Yeah, CPI tomorrow. That'll be fun. Disney can't drop below 85. 80, this is a huge dip. I mean, it can for sure. Anything can happen. I mean, in terms of PE ratio, if we want a perfect one, it could be at 75 and still probably be okay priced for PE ratio. But again, it could also be at 100 and be pretty reasonably priced too. So it's not really, there's some discrepancy there. You know, but it certainly could, I guess. You don't want to never say never, you know, anything could happen there. Disney came in neutral for earnings for the most part. They beat EPS, missed rev, and now they dipped a little bit initially, and they've mostly been sideways since the report. Starting to test the bottom range, though. So, I mean, they're down a little bit. Still got the call ahead. It's right around 86 bucks. Yeah, again, I don't know. I might add some. If we dip enough, I'll add some more to it, but not right now. I'm going to let CPI play out tomorrow, which is kind of an impactful thing, you know. Yeah, the call is semi-important. Yeah, and I mean, when we look at the broader market here, market has been on an absolute tear this whole year. I mean, if you put up a daily chart, here's 2023. You know? So it's been a year. You know what I mean? Like, I remember where people were skeptical of the SPY holding 400s. You know, now we're at 450, basically 445, 450. So the market's up a lot. I don't know whether we're going to keep going up. I mean, we are in a little bit of a dip over the past few days. But I mean, again, when you look at the broad graph, that again looks like this. A small pullback is not unreasonable. Pullbacks are actually healthy. Depends on where we actually put up a line and hold. I mean, we could hold there. There's another level there. There's this previous high up here. And so there's a bunch of different levels that we can kind of pay attention to. But yeah, who knows? Disney back up a little bit. Is at almost 87 cents right now. 87 cents. Again, pretty flat. Not a big move for earnings. Typically, I cover all the major earnings reports, and this is a relatively small move. DraftKings, man. Where's DraftKings at, dude? DraftKings had a crazy big move, right? It has fallen some since earnings, though. DraftKings currently at 28.20s. We also had Plug. We got Magnite, Canopy Growth. How did CGC do? They didn't actually announce when their report was going to come out, but again, total Disney Plus paid subscribers came in at 105.7 million versus 153.6 million expected. So honestly, I'm surprised this hasn't dropped Disney more because, like, okay, so like this is a pretty bad miss here. To put it in perspective, like, look at this. Disney Q3 paid subscribers for Disney Plus came in at 105.7 million. Now, that sounds good, but the analyst estimate for this was 153.6 million. Again, a much lesser number is what they actually showed. ESPN Plus subs came in at 25.2 mil versus 25.8 mil. That was pretty flat, but down a little bit. And again, I don't know if the market has already reacted to this, but yeah, we'll see what the earnings call shows. CPI should be really fun. It should be a really interesting one. Lower is better for CPI. CPI stands for the Consumer Price Index. It's a gauge on inflation. And so typically the market's going to want to see lower inflation, and that's what they're going to react the best with. Yeah, 105.7 versus 153 is pretty rough. I don't know. I think the market typically, is waiting for CPI and on days like today. So again, we've had, some red action over the last few days. The market's actually pretty neutral. So if you look at the SPY over the last couple days, again, the market's pretty flat. To put it into perspective, we opened up yesterday at about 447. We're at 446.30s. Again, on the 4th of August. So last Friday, just to show you how sideways we were at 446 on the SPY. Today we're at 446. And so we're exactly where we were last Friday, which is pretty neutral. Disney's starting to bounce up a little bit though. Again, I'm not saying it's going to continue, but it looks like it's going to start to bounce up some. Here's a daily chart for Disney. Again, Disney's had a pretty rough year. I'm not really feeling this song. It's a little bit too... the right word. I forget the right word, but whatever that word is too much of that. Again, we're at 446.30s right now for the SPY. Disney might start to bounce back. It's at 86.30s. Good data screening sites you use. Benzinga's good. Earnings Whisper is okay. Market Watch. Disney loss in subs comes from overseas. It's a nothing. Yeah, maybe. Day trading is gambling. Well, day trading is certainly incredibly difficult. It depends on what your definition of gambling is, though. Disney almost back up to $87 a share. Almost up to $87 a share. Again, we got about 9 minutes left. The market is gambling, in all honesty. Again, we're starting to bounce up some. But again, overall, we're still pretty flat. Disney currently sitting at 86.56, 86.70 now. So big range as typical with earnings, but slow, choppy. Yeah, I mean, again, day trading is incredibly difficult. If it depends on what your definition of gambling is. If your definition of gambling is risking money, then life's a gamble. All of the stock market is a gamble in that regard. If your definition of gambling is risking money with unfavorable odds, it depends. It depends on the trader. I'll tell you this, for a large majority of people, they're going to lose money day trading. And again, so if you are going to day trade, I really do think it's a good move to try like a funded account program. It limits your risk. You can pay $50 on Top Step and try to get funded. And if you lose, it's not the end of the world. But if you pass it, then you got a lot of the same benefits of putting the money up yourself, which is less risk. In the futures market, you can day trade the S&P, the NASDAQ, currencies, gold, and silver. They're a sponsor of mine. And so because they pay me money, I'm incredibly biased in their favor, of course. But if you want to check them out, again, here's the link. A good way to help support the channel. Disney Parks margin was 29%. That's a big deal for people who thought the margins would be bad. Is Baba earnings tomorrow? Yeah, so tomorrow we do have Alibaba earnings in the morning. It's not really going to matter much because CPI is tomorrow, which is huge. In the evening, we don't really have anything either. It's kind of nothing. And I think that's basically it for the week. Thursday is CPI, Friday's PPI data, and then next week, let me see what we have next week. I know we got something going on. Again, earnings call 4:30 in about 7 minutes, guys. 7 minutes. We'll put this up on screen so people can see it. All right, so again, Disney's earnings call is going to be streamed here live in about 6 minutes. 4:30. Again, subscribe to chat if you haven't already. We appreciate it. We'll put these numbers up on screen too. That'll be helpful. You hear my dog Bruce? Yeah. Yeah, I'm not really a big gambler. I'm really not. Like, I'm not saying I've never lacked discipline with gambles. But like, I'm not really like, again, Carol and I went to the casino a month ago when we were in Michigan. And I'm a poker player, which to people that don't understand poker might not understand that there's a difference. Okay. Hey, hold on. But yeah, so Carol and I went to the casino, and Disney actually rip it up right now. Disney at 87.30s. But yeah, Carol and I went to the casino, and I'm a big poker player because poker is about probabilities and statistics and mathematics. And so I love poker, but I took like $700 out, $800 to go play poker. And then the casino I was at didn't have poker. And so instead of Carol and I walking around the casino and just kind of giving money to the casino, we ended up leaving. I think we were up $50 or we lost $50. But we didn't gamble at all, basically. I think we played like 5 minutes of blackjack, and then we're just kind of like, let's go home. And I think a lot of people wouldn't be able to do that. I think most people that are gamblers, at least, they go to the casino, they're going to spend everything they got, or a lot of it. And again, I'm just not really like that. I don't like losing money. It's not fun for me. I don't get a rush from doing it. I just get disappointed. Yeah, Disney's starting to bounce back here. It's almost up to the volume weighted average price. All right, we're back. No, I was in Michigan when this happened. So I went to Michigan over the summer. All right, Disney over $87 still. SPY moving up a little bit from it. Bro, I'm sorry. My dog needs to just be quiet. Disney had their earnings. Again, 4 minutes, guys. 4 minutes. Dude. Hush, puppy, hush. It's okay. All right. Yeah, it's a bad day to trade, though, Bao. So it's a bad day, man. Most of the market's going to be flat today. We've gotten a little pullback here. We got 3 minutes before the actual earnings call. How does Disney do their earnings call? There we go. Ugh, get it out of here. All right, we're on the hold, or on the call, guys. We're waiting here. Meta at 305.30s. It depends on what the market does. I think the market has been pulling back a little bit over the last few days, which is typically when I start buying stuff up. But I think with CPI tomorrow, there's a little bit more of a risk. Hey, I'm gonna stop this and I'm gonna share this again just to make sure y'all can actually hear this. All right, so y'all should be able to hear it. Y'all can hear the music, correct? Confirm with me that you can hear the music so I can be sure. Also, guys, if y'all want some free stocks, check out Moomoo. Again, Moomoo is really useful. It's what you can see I built this scanner that's been super helpful for my trading. So like, for instance, let me find it. Where'd it go? Oh, here it is. I built this screener that's been super helpful for my trading. It identifies stocks that are around their 20-day lows, that have a PE ratio under 40, that are over 100 billion in market cap. And you can see Apple, Microsoft. We'll see how well it works. I think some of these are still too expensive. But again, the point is you can see hot strategies, arc tops, bearish flags, all that good stuff. You can see a heat map, best performing sectors, pre-market data, all that good stuff. And again, it's zero commission stock trades. It's open the entire time at 4 a.m. in pre-market and all the way to the end of after hours, unlike TOS. And if you open up an account and deposit $100, you get 5 free stocks. You open up a deposit over 1,000, you get 15 free stocks. You open up a deposit over 5K, you get the previous 15 plus Google or Tesla share. And I got Tesla, but if you want to check it out, there's the link. It is a sponsor of mine. Okay, so the music is on. I'm going to go ahead and mute this music, and I'm going to go ahead and mute the actual screen audio so I can press play and listen to this as soon as it starts. See, they're playing Disney music on the background. All right. Scheduled to start pretty soon. All right, so yeah, they've got cheesy Disney song in the background of this. I can't do it. Look, I got 2 kids, and so I'm more used to this than most people, but, like, come on now. It's too loud. I'm sorry, we're waiting here, guys. They're late. They haven't started yet. I'm on live right now. Yeah, they're late. They just did one of their man, sorry guys, I'm waiting for the call. They've got some cheesy Disney music playing in the background. It must be like maybe it's like I don't know if it's the new. All right.
Ladies and gentlemen, thank you for joining today's Walt Disney Company third quarter 2023 financial results conference call.
Can you guys hear?
The call will begin momentarily. We thank you for joining. If you do need assistance while you're waiting, please press star and 0.
Bro, you better not put the cheesy hold music back on. Don't do it. Don't do it. Can y'all hear that? Please don't put the cheesy hold music back on. They did. Okay, good. Y'all can hear it, which is great. They just put cheesy hold music back on now. I'm sorry, guys. Now this is like not cheesy. This is like dramatic music, like violins. I gotta turn this down. This is honestly giving me a headache. Yeah, all good, Anthony. All good, man. So it looks like they're a little bit behind on their stream. At least they gave us an update. Again, here's Disney so far in after hours. Zoom in. Got that. So there's Disney stock. Here is a daily chart. We'll put a 5-minute chart up, maybe a 10-minute chart up here. Again, we're sitting here waiting here, guys. They got me on a cheesy hold music call. So they said they'll be here momentarily. So just bear with me, guys. All right, patiently waiting here, guys. Darth Vader music would be great. I'd rather listen to that for sure because it's better than this. Who said I don't want summer to end? Whatever. Imagine endless skies and fries. Is this a McDonald's commercial? It is. Okay, here we go.
Good afternoon and welcome to the Walt Disney Company third quarter 2023 financial results conference call.
Here we
All
go.
participants will be in a listen-only mode. Should you need assistance, please signal a conference specialist by pressing the star key followed by 0. After today's presentation, there will be an opportunity to ask questions. Please also note today's event is being recorded. At this time, I'd like to turn the floor over to Alexia Quadrani, Executive Vice President of Investor Relations. Please go ahead.
Good afternoon. It's my pleasure to welcome everybody to the Walt Disney Company's third quarter 2023 earnings call. Our press release was issued about 25 minutes ago and is available on our website at www.disney.com/investors. Today's call is being webcast, and a replay and transcript will also be made available on our website. Joining me for today's call are Bob Iger, Disney's Chief Executive Officer, and Kevin Lansbury, Interim Chief Financial Officer. Following comments from Bob and Kevin, we will be happy to take some of your questions. So with that, let me turn the call over to Bob to get started.
Thanks, Alexia, and good afternoon. In the 8 months since I returned, we've undertaken an unprecedented transformation at Disney, and this quarter's earnings reflect some of what we have accomplished. First, the company was completely restructured, restoring creativity to the center of our business. We made important management changes and efficiency improvements to create a more cost-effective, coordinated, and streamlined approach to our operations. We aggressively reduced costs across the enterprise, and we're on track to exceed our initial goal of $5.5 billion in savings. And perhaps most importantly, we've improved our DTC operating income by roughly $1 billion in just 3 quarters, as we continue to work toward achieving DTC profitability by the end of fiscal 2024. I'm pleased with how much we've gotten done in such a short period of time, but I also know we have a lot more to do. Before I turn the call over to Kevin Lansbury, our interim CFO, I'd like to elaborate on the state of our company and the transformative work we are still undertaking. As I've said before, our progress will not always be linear. But despite near-term headwinds, I'm incredibly confident in Disney's long-term trajectory because of the work we've done, the team we have in place, and because of Disney's core intellectual property foundation. Moving forward, I believe 3 businesses will drive the greatest growth and value creation over the next 5 years. They are our film studios, our parks business, and streaming, all of which are inextricably linked to our brands and franchises. Looking to Disney Entertainment Studios, we're focused on improving the quality of our films and on better economics, not just reducing the number of titles we release, but also the cost per title. And we're maximizing the full impact of our titles by embracing the multiple distribution windows at our disposal, enabling consumers to access our content in multiple ways. For example, Avatar: The Way of Water, which is now the 3rd highest grossing film of all time, is also on track to be the biggest ever electronic home video release for Disney domestically. Certain other titles will be sold in the download-to-own window as well. By focusing on big franchises and tentpole films, we're able to generate interest in our existing library. For example, we're seeing tremendous engagement on Disney Plus with the previous Guardians of the Galaxy films, the original Avatar, and the first 4 Indiana Jones movies. But the value of our Disney Entertainment Studios, and the reason this will be a key growth business for us, extends far beyond our library and new releases. What sets Disney apart are the numerous ways we're able to reach consumers with the stories and characters they love, including in our parks and resorts. We'll be opening new Frozen-themed lands at Hong Kong Disneyland and Walt Disney Studios Park in Paris, as well as a Zootopia-themed land at Shanghai Disney Resort. And later, down the road, we will be bringing an Avatar experience to Disneyland, reinforcing the unrivaled worldwide appeal of our brands and franchises. Our Parks and Experience segment overall has had an impressive streak and will continue to be a key growth engine for the company, even as we navigate the cycles that come with operating this business. Our cruise line in particular showed strong revenue and operating income growth in the 3rd quarter. Current Q4 booked occupancy for our existing fleet of 5 ships is at 98%, and we will be expanding our fleet by adding 2 more ships in fiscal 25 and another in fiscal 26, nearly doubling our worldwide capacity. In addition to our cruise line, strong segment results for the quarter were driven by solid performance at our international parks, and we also saw continued strength at Disneyland Resort. Our Asia parks have been doing exceptionally well, reinforcing a clear opportunity for continued growth. Both Shanghai Disney Resort and Hong Kong Disneyland have experienced stronger than expected recoveries from the pandemic, and in Q3, they both grew meaningfully in revenue, operating income, and attendance. We saw softer performance at Walt Disney World from the prior year, coming off our highly successful 50th anniversary celebration. Also, as post-COVID pent-up demand continues to level off in Florida, local tax data shows evidence of some softening in several major Florida tourism markets, and the strong dollar is expected to continue tamping down international visitation to the state. However, Walt Disney World is still performing well above pre-COVID levels, 21% higher in revenue and 29% higher in operating income compared to fiscal 2019, adjusting for Star Cruiser accelerated depreciation. And following a number of recent changes we've implemented, we continue to see positive guest experience ratings in our theme parks, including Walt Disney World, and positive indicators for guests looking to book future visits. This includes strong demand for our newly returned annual passes. We're making numerous investments globally to grow our parks business over the next 5 years, and I'm very optimistic about the future of this business over the long term. The third area that will drive growth and value creation for Disney is our direct-to-consumer business. When you consider our path to profitability in streaming, it's important to remember where we started and how we've adapted based on what we've learned. We overachieved with massive subscriber growth for Disney Plus out of the gate, and we leaned into a spending level to fuel subscriber growth, which had been the key measure of success for many. All of this happened while we were still determining the right strategies for pricing, marketing, content, and specific international market investments. However, since my return, we've reset the whole business around economics designed to deliver significant, sustained profitability. We're prioritizing the strength of our brands and franchises. We're rationalizing the volume of content we make, what we spend, and what markets we invest in. We're deploying the technology necessary to both improve the user experience as well as the economics of this business. We're harnessing windowing opportunities, perfecting our pricing and marketing strategies, maximizing our enormous advertising potential, and we're making extensive Hulu content available to bundle subscribers via Disney+. As I announced last quarter, we're moving closer toward a more unified one-app experience domestically to pair high-quality general entertainment with content from our popular brands and franchises for our bundle subscribers. It's a formula for success that we have already proven in international markets with our Star offering on Disney+. We see a future where consumers can access even more of the company's streaming content all in one place, resulting in higher user engagement, lower churn, and greater opportunities for advertisers. We're also very optimistic about the long-term advertising potential of this business. Even amid a challenging ad market, this quarter we began seeing early signs of improvement. And I'm pleased to announce that as of the end of Q3, we've signed up 3.3 million subscribers to our ad-supported Disney Plus option. And since its inception, 40% of new Disney Plus subscribers are choosing an ad-supported product. On our pricing strategy, this year alone, we've raised prices in nearly 50 countries around the world to better reflect the value of our product offerings, and the impact on churn and retention has outperformed our expectations. Later today, we will release details regarding upcoming streaming price increases. And I'm pleased to share that our ad-supported Disney Plus subscription offering will become available in Canada and in select markets across Europe beginning November 1st, while a new ad-free bundled subscription plan featuring Disney Plus and Hulu will be available in the U.S. on September 6th. Maintaining access to our content for as broad an audience as possible is top of mind for us, which is why pricing for our standalone ad-supported Disney Plus and Hulu offerings will remain unchanged. I'd also like to note that we are actively exploring ways to address account sharing and the best options for paying subscribers to share their accounts with friends and family. Later this year, we will begin to update our subscriber agreements with additional terms on our sharing policies, and we will roll out tactics to drive monetization sometime in 2024. Our DTC ambitions also extend to our sports business, taking our ESPN flagship channels direct to consumer is not a matter of if, but when. And the team is hard at work looking at all components of this decision, including pricing and timing. It's interesting to note that ratings continue to increase on ESPN's main linear channel, even as cord cutting has accelerated. This rating strength creates tremendous advertising potential across the board. Our total domestic sports advertising revenue for linear and addressable is up 10% versus the prior year, adjusted for comparability, which speaks to the fact that the sports business stands tall and remains a good value proposition. We believe in the power of sports and the unique ability to convene and engage audiences. Yesterday, it was announced that ESPN has entered into an exclusive licensing arrangement with Penn Entertainment to further extend the ESPN brand into the growing sports betting marketplace. This licensing deal will offer a compelling new experience for sports fans that will enhance consumer engagement. We're excited to offer this to the many fans who have long been asking for it. Overall, we're considering potential strategic partnerships for ESPN, looking at distribution, technology, marketing, and content opportunities where we retain control of ESPN. We've received notable interest from many different entities, and we look forward to sharing more details at a later date when we're further along in this process. Looking to our broader linear business, while linear remains highly profitable for Disney today, the trends being fueled by cord cutting are unmistakable. And as I've stated before, we're thinking expansively and considering a variety of strategic options. However, we're fortunate to have an array of extremely productive television studios that we will rely on to continue providing exceptional content for audiences well into the future. And speaking of the content we create, I'd like to say a few words about the ongoing strikes. Nothing is more important to this company than its relationships with the creative community, and that includes actors, writers, animators, directors, and producers. I have deep respect and appreciation for all those who are vital to the extraordinary creative engine that drives this company and our industry. And it is my fervent hope that we quickly find solutions to the issues that have kept us apart these past few months. And I am personally committed to working to achieve this result. In closing, I returned to Disney in November, and I've agreed to stay on longer because there is more to accomplish before our transformation is complete, and because I want to ensure a successful transition for my successor. In spite of a challenging environment in the near term, I'm overwhelmingly bullish about Disney's future for the reasons I shared at the beginning of this call. The work we've done over these past 8 months, our core foundation of creative excellence and iconic brands and franchises, and because of the unrivaled talent we have at every level here at Disney. I have the highest confidence in our leadership team today, and I'm enormously proud of the ways each of them is helping steer the company through this moment of great change. And with that, I'll turn things over to Kevin.
Thanks, Bob. It's good to be here, and good afternoon, everyone. Our fiscal third quarter diluted earnings per share, excluding certain items, were $1.03, a decrease of 6 cents versus the prior year. In the coming months, we will be presenting recast financials in line with our new reorganized segments, Disney Entertainment, ESPN, and Parks, Experiences, and Products. So today will be the last earnings call where we will discuss our numbers under the existing structure. Now, turning to this quarter's results. Starting off with direct-to-consumer, as Bob referenced earlier, we've improved direct-to-consumer operating results by $1 billion in just 3 quarters. For Q3, operating losses improved by approximately $150 million versus the prior quarter, and by approximately $550 million versus the prior year. These results outperformed the guidance we gave on the last earnings call, largely due to lower than expected expenses, including from realizing SG&A savings sooner than initially expected. Disney Plus core subscribers grew by nearly 800,000 during the third quarter, in line with the commentary we made at our last earnings call, with international growth more than offsetting modest domestic net losses. As Bob mentioned, our progress will vary from quarter to quarter, and we are more focused on overall economics versus pure sub-growth. But currently, we do expect that in the fourth quarter, we will see core Disney Plus net adds rebound, with growth both domestically and internationally. Disney Plus core ARPU increased sequentially by 11 cents, driven by higher per subscriber advertising revenue domestically, as well as price increases in certain international markets. With over 40% of gross ads opting for the ad tier, the domestic Disney Plus ad tier is continuing to improve our ARPU, and we look forward to the additional market launches announced today, which should serve as a stepping stone on our path to profitability. Disney Plus Hotstar subscribers declined this quarter as we adjusted our product from one centered around the IPL to one more balanced with other sports and entertainment offerings. I would also note that this business, with its significantly lower ARPU compared to core Disney Plus, is not a material component of our overall D2C financial results. We will therefore continue to focus our commentary on the core Disney Plus product. Hulu and ESPN Plus subscribers were roughly comparable to Q2. Hulu remained profitable in the third quarter, with advertising revenue increasing versus the second quarter, benefiting sequentially from a higher sell-through rate. In Q4, we expect D2C ad revenue to continue to benefit from higher advertiser demand at Hulu, as well as from the ramp-up of the Disney Plus ad tier. As we work toward achieving D2C profitability by the end of fiscal 2024, we don't necessarily expect the progress to be linear each quarter, as the impacts of the transformative work we are doing take time to realize. We expect to see more meaningful improvement in our D2C losses by the middle of fiscal 2024. These expectations and plans remain subject to all of the risks and assumptions we previously identified and are noting here today, which will require close and ongoing assessment. But we remain encouraged by the early results we've already realized and are optimistic about our path ahead. Moving on to our content sales line of business, operating results declined by a little over $200 million versus the prior year. Lower results in the third quarter versus the prior year were due to lower TV, SVOD, and theatrical results. For Q4, we expect this business to generate operating losses up to $100 million worse than last year's fourth quarter. And at Linear Networks, operating income declined versus the prior year by $580 million, driven by declines at both domestic and international channels. The decrease at domestic channels was driven by lower advertising and affiliate revenue and by higher programming and production costs driven by the NBA and the new Formula One agreement. While domestic linear advertising revenue declined year over year, ESPN ad revenue increased by 4%, demonstrating the relative strength of sports. Quarter to date, ESPN domestic linear cash ad sales are pacing down, reflecting in part the absence of the Big Ten this year. It's worth noting, however, that the absence of the Big Ten is expected to drive overall operating income favorability in Q4 versus the prior year. The fourth quarter will also hold one additional Monday Night Football game versus the prior year. Linear advertising continues to see impacts from market softness. While sports is healthy, entertainment continues to face headwinds. Note that we expect D2C advertising year-over-year growth to partially offset linear declines in the fourth quarter. And we wrap this year's upfront with overall volume roughly in line with the prior year. Growth in addressable revenue increased, representing over 40% of the total upfront volume, and sports pricing is up single digits across the board. Domestic linear networks affiliate revenue decreased by 2% from the prior year, due to a 6-point decline from fewer subscribers, partially offset by 4 points of growth from contractual rate increases. International channels operating income decreased versus the prior year, driven by lower advertising revenue and, to a lesser extent, an unfavorable foreign exchange impact. Our parks, experiences, and products portfolio of businesses continues to be an earnings and free cash flow growth driver for the company, with both revenue and operating income increasing by more than 10% versus the prior year. International parks continued its strong growth trend, with year-over-year operating income increasing at all our international sites, but most significantly at Shanghai Disney, which saw record highs from a revenue, OI, and margin perspective. At domestic parks and experiences, operating income was up 24% versus pre-pandemic results in fiscal 19, but declined 13% versus the prior year. In addition to the inflationary cost pressures we have discussed on prior calls, and some of the near-term headwinds at Walt Disney World that Bob mentioned earlier, results reflect an approximately $100 million accelerated depreciation charge related to the closure of the Galactic Starcruiser. These drivers were partially offset by favorable performance at our cruise line and at the Disneyland Resort. While Walt Disney World results were down year over year, as Bob mentioned, operating income was nearly 30% higher versus 2019 when adjusting for the Starcruiser accelerated depreciation. Domestic parks attendance grew slightly year over year, reflecting comparisons against last year's strong trends coming out of the 50th anniversary at Walt Disney World. Per cap spending was comparable to the prior year, with contributions from pricing, Genie Plus, and higher food and beverage spend, offset by attendance composition changes and lower merchandise spend. Excluding the impact of the Starcruiser accelerated depreciation, domestic parks and experiences operating margins in Q3 were roughly 3 percentage points below the prior year, and DPEP margins were slightly higher than the prior year. We continue to expect some moderation in demand at our domestic parks as we compare against our highly successful 50th anniversary celebration at Walt Disney World, and the burn-off of pent-up demand persists, while elevated travel costs are impacting international visitation. We are also seeing continued cost pressures in the fourth quarter, predominantly from labor wage rate growth, coupled with $150 million of remaining accelerated depreciation for the Galactic Starcruiser. However, we still expect all-in Q4 operating margins at DPEP to exceed the prior year due to the ongoing strength of recovery at our international parks and cruise line. Putting this all together, excluding the impact of accelerated depreciation for the Starcruiser, we are still expecting full-year total company revenue and segment operating income to grow at a high single-digit percentage rate versus the prior year. We currently expect fiscal 2023 content spend to come in at approximately $27 billion, which is lower than we previously guided due to lower spend on produced content, in part due to the writers and actors strikes. We now expect capital expenditures for the year to total $5 billion. This is lower than our prior guide, primarily due to spending timing shifts for various projects across the enterprise. In the midst of the transformative work we have been doing, we are prioritizing long-term free cash flow growth and have generated $1.6 billion of free cash flow in the third quarter. Our balance sheet remains strong, with our single A credit ratings reflecting that strength. We have made significant progress deleveraging coming out of the pandemic, and we continue to approach capital allocation in a disciplined and balanced manner, prioritizing investments to generate future growth while also keeping an eye toward shareholder returns. And to that point, as we've mentioned before, we still expect to be in a position to recommend that the board declare a modest dividend by the end of this calendar year, with the intention to recommend increased shareholder returns over time as our earnings and free cash flow power grows. And with that, I will turn it back over to Alexia for Q&A.
Thanks, Kevin. As we transition to the Q&A, we ask that you please try to limit yourself to one question in order to help us get to as many out as possible today. And with that, operator, we're ready for the first question.
And ladies and gentlemen, we'll now begin that question and answer session. Once again, to ask a question, you may press star and then 1. To withdraw your questions, you may press star and 2. Our first question comes from Phil Cusick from JP Morgan. Please go ahead with your question.
Hi, thank you. Bob, the linear business is clearly under pressure, and you made it clear recently that all options are being considered. I'm curious, though, what the practical considerations are of separating assets like ABC, National Geographic, or others from both ESPN, where sports are integrated, or from Hulu, which is kind of the next generation distribution platform. Can you talk about that? And then second, can we assume that most of those TV assets have been fully depreciated? Thank you.
Clearly, if we are to do anything significant in terms of called strategic direction for the linear nets, we have to keep in mind the need for content to ultimately fuel our DTC businesses, notably, as you mentioned, Hulu. So anything that is to be done would be done with an eye toward maintaining a rich flow of content to fuel our growth business, and that will be streaming. There's obviously complexity as it relates to decoupling the linear nets from ESPN, but nothing that we feel we can't contend with if we were to ultimately create strategic realignment.
And Phil, this is Kevin. With respect to the assets, these have been around for quite a while at this point, and we're not going to comment specifically on where they sit from a depreciation standpoint.
Thank you. Next question, please.
Our next question comes from Jessica Reif Ehrlich from BOA. Please go ahead with your question.
Thank you. Bob, maybe just to follow up on your prepared remarks and film being core strategic. Can you share with us how you plan to improve the movie performance, or maybe the time frame, or create more original content? Just give us more color. And then a follow-up to something you said on DTC and Password Crackdown. Is this a fiscal 24 full year? Like, will you be done by the end of the year? And is it on a global basis? How many password sharers do you think there are on your platform?
So the second part of your question, Jessica, regarding password sharing, we already have the technical capability to monitor much of this, and I'm not going to give you a specific number except to say that it's significant. What we don't know, of course, is as we get to work on this, how much of the password sharing, as we basically eliminate it, will convert to growth in subs. Obviously, we believe there will be some, but we're not speculating. What we are saying, though, is that in calendar 24, we're going to get at this issue. And so while it is likely you'll see some impact in calendar 24, it's possible that we won't be complete, or the work will not be completed within the calendar year. But we certainly have established this as a real priority, and we actually think that there's an opportunity here to help us grow our business. Regarding our studio performance, let's put things in perspective a little bit. The studio has had a tremendous run over the last decade, perhaps the greatest run that any studio has ever had, with multiple billion-dollar hits, and including, by the way, two that were relatively recent, or one in particular, Avatar, The Way of Water. And we also had a pretty strong performance with Guardians of the Galaxy 3, which has done, I think, approximately $850 million in global box office. That said, the performance of some of our recent films has definitely been disappointing, and we don't take that lightly. And as you'd expect, we're very focused on improving the quality and the performance of the films that we've got coming up. It's something that I'm working closely with the studio on. I'm personally committed to spending more time and attention on that as well.
All right, operator, next question, please.
Our next question comes from Ben Swinburne from Morgan Stanley. Please go ahead with your question.
Thank you. Good afternoon. Bob, the press is out with the price increase information for later this year tonight. I'm just wondering, now that you've been through one Disney Plus price increase here in the U.S. and multiple Hulu and ESPN increases, sort of how you're thinking about the pricing power of the product as you go into these even more significant increases, and whether you think you can, hold your customer base as you raise prices. And obviously some big news with ESPN Bet. Why now and why Penn? Can you just talk about your vision, or Jimmy's vision, for the ESPN product over time that stems from this announcement, and other thoughts on ESPN's future?
Ben, as you know, I think as we've said before, we took a pretty significant price increase at Disney Plus sometime late in calendar 22. Mm-hmm. And we really didn't see significant churn or loss of subs because of that, which was actually heartening. It's important to note, though, that the price increase that we've just announced is a price increase for the premium product or the non-advertiser supported product. We're actually keeping the advertiser supported product flat in terms of prices. That's being done for a reason. Obviously, as been noted by Kevin in his remarks, the advertising marketplace for streaming is picking up. It's more healthy than the advertising marketplace for linear television. We believe in the future of advertising on our streaming platforms, both Disney Plus and Hulu, and we're obviously trying with our pricing strategy to migrate more subs to the advertiser-supported tier. It also should be noted, as I think I mentioned in my remarks, that a substantial amount of new subscribers to Disney Plus are signing up for the ad-supported tier, which suggests that the pricing is working for us in that regard. So we're looking at this very carefully. One thing I think that I should also note is that we grew this business really fast, really before we even understood what our pricing strategy should be or could be. And we're really just getting at, and I'd say in the last 6 months, a pricing strategy that's really aimed at enabling us to improve the bottom line, ultimately to turn this into a growth business, and as a component of that, obviously to grow subs.
Anything on ESPN?
On ESPN Bet, you say, why now? Well, we've been in discussions with a number of entities over a fairly long period of time. It's something that we've wanted to accomplish, obviously, because we believe there's an opportunity here to significantly grow engagement with ESPN consumers, particularly young consumers. And Penn, why Penn? Because Penn stepped up in a very aggressive way and made an offer to us that was better than any of the competitive offers by far. And we like the fact that Penn is going to use this as a growth engine for their business, and actually believe and trust in their ability to, in this partnership, to grow their business nicely while we grow ours.
Thank you.
Operator, next question, please.
Our next question comes from Michael Nathanson from MoffettNathanson. Please go ahead with your question.
Thanks. Hey, Bob, I have two for you. One is, given the thinking you've done about the future of Disney, why doesn't it make sense to create two Disney companies? One focused on parks, CP, Disney Plus, and then the studio IP that drives that flywheel, and then one on everything else. So why not make a clean break? And then secondly, on ESPN, you've been talking about partnerships. I wonder if you have a vision for the streaming content vision of ESPN that's different than the linear one we see, perhaps a sports bundle with either other networks or with lead partnerships. So can you just expand on how the product will look differently down the road in streaming than it does now in linear?
Michael, on the first part, I'm not going to comment on the future structure of the company or the asset makeup of the company. As I've said, we're looking at strategic options both for ESPN and for the linear networks, obviously addressing all the challenges that those businesses are facing. I'm looking forward to reading your thesis on it. Maybe you'll give us some ideas about it, but I'm not going to make any comments about it right now. Regarding the second question and ESPN, the strategic partnerships that we're looking to create and that we're actually in discussions about are aimed at accomplishing a few things. One, content, meaning increasing the content that ESPN offers, and two, possibly, I'll call it distribution and marketing support. And it's possible that we'll be able to do both. And this is all being done with an eye toward the inevitability of taking ESPN flagship over the top. So when we look ahead and we see, business that will be primarily a direct-to-consumer business, we obviously have an eye toward how much content do we need in order to make that a successful business. That obviously ties to what the pricing model need to be, and actually, how much distribution support we need. We've benefited greatly from the distribution support in the old business model from cable and satellite. Obviously, when you go DTC, you're kind of doing it on your own, or maybe not, or maybe there's an opportunity with another entity to help in that regard. So we're basically looking quite expansively. I must say we're extremely encouraged with all the interest that we've had already in this regard. And I think it's safe to assume, as we ultimately turn this into a streaming business, while we have a phenomenal hand right now, better than anyone else in terms of the content that ESPN offers, that we believe that adding more content in under economical circumstances might be a wise thing.
Okay. Thanks, Bob.
Operator, next question, please.
Our next question comes from Stephen Cahill from Wells Fargo. Please go ahead with your question.
Thank you. Bob, you said you're now on track to exceed that initial goal of $5.5 billion in cost savings, and DTC came in ahead in the quarter. As you think about the future of this business long term and getting to kind of the price and cost structure that you're aiming for, do you have any expectations for longer term DTC margins? It just seems like you're meaningfully below where Netflix was at a similar revenue scale. So I'm wondering how you think about that 15 or 20% margin level as that business gets above $20 billion in revenue this year. And then just secondly, as a follow-up, given that you have the Hulu put coming up next year, what are your thoughts on your ability to fund that transaction as we head into that time horizon? Thank you.
Our streaming business is still actually very young. In fact, it's not even 4 years old. It launched in November of 2019. And we'd love to have the margins that Netflix has. They've accomplished those margins, though, over a substantially longer period of time. And they've done so because they figured out how to really carefully balance their investment in programming with their pricing strategy and what they spend in marketing. Because we're new at all of this, we actually have not really achieved the kind of balance we know we need to achieve in terms of cost savings and pricing and money spent on marketing. And of course, all the other things that we're looking at from a technological perspective that grows engagement with our customers, like for instance, recommendation engines would be one example of that have the ability to improve performance or obviously grow consumption. So I would say that, and I obviously I can't emphasize enough the time that we spent and the effort that we spent on managing costs. We've done a tremendous job in a very, very short period of time of exceeding the cost reductions that we said we were going to achieve. And that's obviously a major step in the direction of improving our margins. Pricing, as we've talked about earlier on this call and in our comments, is another way to do that. Password sharing is another way to do that. Getting the technology in place to grow engagement, the advertising side of this business is another. So I'm reasonably optimistic and hopeful that we will be improving our margins in this business significantly over the next few years, but I'm not going to make any further predictions than that, except the good news is that we know how much work we have to do. We know the work that we have to do as well.
And Stephen, I'll answer the question with respect to the Hulu put. So I'll remind everyone that the floor for that put is about $9.2 billion. We're very comfortable with our current liquidity position. We've got about $11.5 billion of cash on our balance sheet. Got about $10.5 billion worth of revolving credit facilities and commercial paper. And so we're going to have plenty of future cash flow to help fund all of this going forward. I would also like to note that from a balance sheet perspective, we've got a strong single A credit rating that reflects the strength that we see in our balance sheet. We made significant progress recently, deleveraging coming out of the pandemic. We're prioritizing free cash flow as a company, and we're being really disciplined and smart about how we go about allocating capital across the company. And last but not least, as I noted in my prepared remarks, we hope to still be in a position, or we plan to still be in a position at the end of this year to recommend to the board of directors that we put a modest dividend out.
Next question, please.
Our next question comes from Kannan Venkateshwar from Barclays. Please go ahead with your question.
Thank you. So Bob, I mean, on the ESPN side, you've spoken about the need for partners. Could you talk a little bit about the priorities when you look at partners? Is it more in the form of direct capital infusion or maybe some kind of reach on the distribution side when it comes to streaming? What are the objectives you're really solving for? And then Kevin, maybe as a follow-up to the guidance, just triangulating between some of the segment guidance that you just gave and trends in the first 3 quarters. The full year high single-digit guide reiteration is obviously great, but it will need more acceleration in Q4 than we've seen in the first 3 quarters of OI. So if you could just talk through what the drivers of that acceleration are, that would be helpful. Thank you.
Kannan, we're not necessarily looking for cash infusion when it comes to partners. We're looking for partners that are going to help ESPN successfully transition to a DTC model. And that, as I've said, can come in the form of either content or distribution and marketing support or both.
And Kannan, can you repeat your second question, please?
So in terms of the guidance for high single-digit OI growth, just triangulating between the trends in the first 3 quarters and some of the segment guidance in the quarter, it seems to imply growth in the fourth quarter will be higher for OI. And so I just wanted to understand what the drivers of that acceleration are.
Yeah, Kannan, there's very significant growth across our direct-to-consumer business and at our Parks and Experiences business also. So those 2 businesses predominantly are the big growth drivers as you begin to look at relative to the prior year where we're getting that kind of growth.
Operator, next question, please.
Our next question comes from Brett Feldman from Goldman Sachs. Please go ahead with your question.
Thanks. So I'm curious how your experience with Disney Plus Hotstar has shaped your view on your long-term international streaming strategy. Are you thinking about maybe exiting those markets or any markets and maybe focusing more on content licensing or partnerships? And is it essential that you reshape that international strategy in any way to meet your long-term profitability objectives?
We actually have been looking at multiple markets around the world with an eye toward prioritizing those that are going to help us turn this business into a profitable business. What that basically means is there are some markets that we will invest less in local programming but still maintain a service. There are some markets that we may not have a service at all. And there are others that we'll consider, I'll call it high potential markets, where we'll invest nicely for local programming, marketing, and basically full service content in those markets. Basically what I'm saying is not all markets are created equal. And in terms of our march to profitability, one of the ways we believe we're going to do that is by creating priorities internationally.
All right. Operator, we have time for one more question.
Our next question comes from Michael Morris from Guggenheim. Please go ahead with your question.
Thank you very much. Good afternoon, guys. So on the theme of considering options for Disney, there was an article published recently that speculated that the entire company could be sold to a larger technology company. So, Bob, my straightforward question is, do you see a plausible scenario where the entire company would be sold? Maybe a bit more broadly, though, when you think of maximum value of the Disney enterprise, do you think that can be achieved by being more aligned with a single technology partner, or is that value maximized through partnering with a variety of tech platforms? And if I could just sneak one in on the Penn Gaming announcement, will you forego advertising partnerships with all other betting or sports gaming partners? And if so, how much impact will that have in exchange for building value in this partnership? Thank you.
Michael, I just am not going to speculate about the potential for Disney to be acquired by any company, whether they're a technology company or not. Obviously, anyone who wanted to speculate about such things would have to immediately consider the global regulatory environment. I'll say no more than that. It's not something that we obsess about.
Okay. And then, Michael, with respect to any foregone economics or no longer accepting advertising from other gaming companies, I don't see us in a position where we would ever be in that situation. So.
Okay, thanks for the question. And I want to thank everyone for joining us today. Note that a reconciliation of our non-GAAP measures that were referred to on this call to equivalent GAAP measures can be found on our investor relations website.
All right, guys. So
let me also remind you that certain statements on this call, including financial estimates or statements about our plans, guidance, or expectations, or other statements that are not historical in nature.
So I'm assuming that's it for this earnings call.
Under the securities law.
We
make these statements on the basis of our views and assumptions regarding future events and business performance at the time that we make them, and we do not undertake any obligation to update these statements. Forward-looking statements are subject to a number of risks and uncertainties, and actual results may differ materially from the results expressed or implied in light of a variety of factors. These factors include economic or industry conditions, competition, and execution risks, including in connection with our business plans, organizational structure, and operating changes, cost savings, earnings expectations, and drivers of growth, and our DTC content and how it is made available on our platform, subscriber, advertising, and revenue growth and profitability.
Okay.
In particular, our expectations regarding DTC profitability are built on certain assumptions.
All right, I'm going to just close this down. They're giving a bunch of data. Again, guys, if you haven't already, check out TopStep. Tomorrow we have CPI, so TopStep, you can join their wait list. If you want to learn to day trade, TopStep's the easiest way to do it. They fund traders, but if they can prove they're profitable through like a challenge format, and the challenge really does help build your skill. But if you lose, it's not the end of the world. But if you pass it, they give you a demo. The base one is $50K. If you can hit 3K without losing 2K, that's essentially the base challenge, which is a very reasonable 2-to-3 ratio. There's some other rules you want to follow, and they're a sponsor of mine, but it really is a great way to learn day trading without taking on a lot of risk. And you can day trade the NASDAQ, currencies, gold, silver, the S&P 500, and what's called the E-mini and futures, and there's no PDT rule. And so it really is a great way to try to get funded if you're good enough. And if you don't, you'll lose much less than putting up the money yourself. You can check out the link there. Also, guys, the other sponsor we have is a company called Moomoo. Again, really nice company. You can see the best performing sectors here. You can see what's moving in after hours right now. INGN, VTGN are all moving. You can see a heat map, which is mostly red. I could put up some strategies and see symmetrical triangles, diamonds, bearish wedges. I built a screener here. These are stocks that have greater than 100 billion market cap with a PE ratio under 40 that are around the 20-day lows. You can see Oracle, Apple, Microsoft, and Pepsi all around those levels. I'll have to look at Pepsi. Pepsi might be a nice little dip option. But again, we're looking at that as well, guys. Again, check out Moomoo. If you open up an account and deposit at least $100, you get 5 free stocks. You open up a deposit over 1,000, you get 15 free stocks. You open up a deposit over 5K, you get the previous 15 plus a free share of Google or Tesla. And so again, check it out. Get some free shares. Check out TopStep. Great ways to help support the channel. Again, CPI data drops tomorrow. This is incredibly relevant market data, incredibly important market data. And again, be here bright and early. Hit the subscribe button. Hit the notification bell. 8:30 tomorrow morning. We will be live much earlier than that. So be ready. Y'all be safe. I'll see you guys later. Shout out to Disney. Hey, listen, did I not tell you guys? I told you, Disney, for whatever reason, retail traders are talked into betting against the most successful and largest companies in the world. It's a sucker's bet, guys. It really is. I get it. You watch The Big Short. I get it. You want to be cool like Michael Burry. You're not Michael Burry. And listen, the reality of it is most of these companies are going to go up long term. Disney's going to go up long term. Apple's going to go up long term. Amazon is going to freaking go up long term. Trying to pick the small notice, like the small little windows of opportunity on the downside is a sucker's bet. It's something that rookie traders are going to be doing. And so don't be dumb. All right. Don't short the most successful companies in the world. Guys, listen, I don't know what's going to happen. Maybe we get a pullback. Be smart. That's all I'm saying. Just be smart. Maybe I'm wrong. I don't know. Y'all be good. I'll see you guys tomorrow.